a topic that always comes up during performance appraisals. You always think you are worth more. They think always that you are worth less. And in addition to that, the chairman of the board has the habit of writing in the annual reports that people are our most important asset without ever saying, you know, how much these assets are worth. You must understand that the accountants account for forklift trucks, for furniture, for PCs, but never account for people. And therefore, my topic tonight is to talk about the valuation of what really matters. Now, it is a topic that has emerged very rapidly to everybody's attention only in the last 30 or 40 years. Various writers talk about it with expressions like knowledge capital, knowledge assets, knowledge management, etc., etc., etc. The problem with all of these kind of designations is that they are imprecise. They are usually written by sociologists and not by engineers, which means that they are high on rhetoric and low on facts. Now, to define what we mean by knowledge assets, I want to point out to you that payroll expenses are the bodies of the people who are walking out of this building. The knowledge assets is the brains that they carry with them. The accountants will tell you to the nearest penny what is the payroll expense and what are the benefits. The accountants and management will really not know how much of the knowledge is being carried out every night down the elevator into the parking lot. And that is really an issue that is becoming increasingly relevant to the future of America. Let me point out to you that you are now dealing with a set of metrics which steer the investment public and students, particularly MBA students, away from focusing on knowledge. Because the generally accepted metrics today measure the returns on finance capital. In other words, if productivity is output over input, what Wall Street listens to is ROE, return on equity, and that is profit divided by shareholder equity. Now, those of you who have taken your obligatory course in accounting, or maybe not, would know that shareholder equity is strictly fixed assets, receivables, inventory minus debt, which means the equations flush out any humanity out of the productivity equation. So I fundamentally reject the idea that the metric of wealth, particularly in the 21st century, is a return on financial capital. The question is, what do we put instead? Well, we have to recognize that financial statements will not give us a clue. The balance sheet accounts will only focus on net financial assets. And the only time you will ever see the value of knowledge is when a company is sold, merged, or maybe in bankruptcy, or when its shares are sold on the market. Because every day, if your shares are listed on a stock exchange, somebody says this company is worth more than its book value, than its financial capital. And I would like to now focus on this issue of value, not as set by accountants, but as set by the market. This is a variation on what Lord Kelvin said 200 years ago, that you will never understand anything you're talking about unless you can measure it. In fact, I suggest to the faculty of this fine school to put this thing as one of the precepts for a School of Engineering and Information Sciences, that until you can articulate the measures of what you are talking about, you will not be able to precisely define what you're talking about. My presentation today is divided in 4 parts, and it will start with the whole idea of what's called market valuation of knowledge assets. I want to draw to your attention facts. ExxonMobil, with or without the chairman's retirement pay, has sales of $263 billion. They have a shareholder equity of $101 billion and a market valuation of $330 billion. In other words, the market values ExxonMobil, including the esteemed chairman and CEO, at 3 times what the assets show as it being worth, including the assets which are still in the ground. Walmart is worth 5.13 times more than its equity. General Motors barely makes it. Its market valuation is actually less than shareholder. In other words, what this number tells you that selling General Motors is actually more profitable than holding on to it, which is a tragic fact-finding, but I'm just giving you an indication of what these kind of ratios indicate. Again, the big winner is General Electric Corporation. I have just published a ranking of 100 companies in Baseline magazine. In the Baseline magazine also has an attached spreadsheet which would allow you to do your own calculation. And of course, you cannot do evaluation of your spouse that way, because there you have a monopoly and there is no price. She's priceless. So don't try it in a family environment. But at any rate, the market value multiplication is what I define as market pricing of the knowledge assets. And therefore, you can then take the market valuation, subtract from the market value the shareholder equity, which is then the knowledge assets. In other words, the knowledge assets is the surplus beyond the buildings, the licenses, the patents, and the tangible part of the company. And therefore, that is a definition which is today generally accepted as one way of looking and calculating of knowledge assets. So again, you see here that knowledge to equity ratio varies, and now it clearly shows that Walmart is an exceptional company. By the way, Walmart, in my view, is an information systems integrator. They are not a merchandising company. They are just selling goods as a byproduct, but fundamentally, when you look at the value added of the company, it is in knowledge assets, and it is in the way how they are able to establish an information network that's global. There are some significant implications from viewing corporations and organizations from that standpoint. Now, what I want to point out to you, however, that the market valuation, particularly the stock market valuation of any corporation, is a flighty and uncertain phenomenon. I'm just showing to you the stock market prices, and it depends whether you looked at Walmart on January 15 in 2003, or whether you looked at it on one of the peaks, which was in a year before. Point is that this shows an almost 33% decline in knowledge assets. The question is, did really all the knowledge that is embodied in Walmart decline by 30%? Did the Walmart management become dumber in 1 year by 30%? And the answer is, that is clearly arguable. This is one of the reasons why market-based pricing of knowledge assets is something that has to really look at long-term valuations. In my baseline article, which has just been published in April, I'm using 3-year moving average to look at the long-term trends. And it, by the way, shows that Walmart knowledge capital and knowledge assets are declining as Walmart has become a target for interest groups to try to extract out of Walmart some of the advantages that the company has enjoyed, which means social interactions have also an effect on corporations, and if a corporation is not able to deal with bad public relations and court actions and so forth, it shows that perhaps its knowledge of operations is deteriorating. So let me then sum up part one. What you have is market valuation minus shareholder equity. Market valuation of knowledge assets reveals the inadequacy of financial reporting, and it offers you a quick approximation of the worth of knowledge capital. Therefore, if you are going to go for a job interview, you may have a very pleasant personnel director talking to you. You may have to look behind the facade of this company and say whether this company is really as smart as they allege. And sometimes they are, and sometimes they are not. And I will be showing you some examples of that. So now the question is, all right, how do you add value to a corporation? If the value is recognized by the market is the market valuation, the question is, how do you increase that assessment on the part of the people who are willing to buy or sell your stock or your company? This has very much to do with the whole issue of acquisitions and mergers. What kind of a premium do you pay? What is the fair price to pay for a company? So the question then is, what is some of the underlying rationale for accounting or knowledge economics, which is, by the way, a new branch of economics? And my position on this thing is that what today is considered to be the financial value of a company called equity capital, that has become a commodity. Capital is sloshing all over the world. There are trillions of dollars worth of cash available to move across national borders on a slight uptick or downtick in interest cost available. One day I was standing at the currency trading desk of JP Morgan Chase, and it was a Friday afternoon, and there was a room full of computers, and the CIO was taking me through, and I said, well, this is a fairly peaceful, placid kind of a computer room. He said, Paul, you just don't understand it. Let me walk to the console and tell you what's going on. This was a particularly bad day when there has been a devaluation of the British pound. In a period of 45 minutes, according to the console display, $750 billion were flushed through those banks of computers in currency trading. So what you have to understand today is that there's an enormous amount of capital out there. The Chinese have almost $1 trillion of dollars sitting in their bank accounts. The Arabs are ready to buy your ports. because they have so much cash they don't know what to do with it, and so forth. So money is not anymore a source of competitive advantage. You have to pay a price for it. If you are a good company, you pay less. If you are a bad company, you pay more. When you look at a successful company, you will find that the part which represents knowledge is actually greater than what is represented as equity capital. My position is, and I think this is a fundamental guidance for national policy, is that from now on, the factories that make knowledge capital, by the way, this university is a factory for manufacturing knowledge capital. That's the way I, as an industrial engineer, look at this place. And so the question is, are you going to be acquiring knowledge capital that is going to give you a competitive advantage? If you don't have knowledge capital, at best you can hope for is being paid for a competitive wage, which most likely is going to be equal to the price of consultants from India. This is a non-trivial kind of a discussion. This is very personal. Don't take this thing as some kind of an academic exercise. Now, why is this so? And that has to do with the laws of economics. And these are curves which most likely you have never seen before. Well, you have seen the one to the left, which basically says incremental revenue create incremental cost, and the equilibrium price is when marginal costs equal marginal revenue. Correct, Dean? And I passed the test. Wrong. That is not the way the world works. That is the way the world worked during the Industrial Revolution. And in the United States, it sort of worked until about 1950. After that, the knowledge capital became more important. And one of the amazing things about knowledge capital is what's called the perverse economics of knowledge. To the right, you see the equilibrium equations. The point of knowledge capital is the more you have, the more knowledge capital you have, the lower your costs. In other words, it is exactly the opposite than the classical economics based on assets. Let me give you an example. Microsoft, with increases in revenue, lowers its cost. The last 1 million copies of Microsoft Office costs only the cost of packaging material and the cost of a floppy plus shipping cost. So what you pay, whatever you pay, let's say $392 if you're honest, you know, you are basically buying a commodity, which is mostly knowledge, that costs at best $4.50. So that means that in a knowledge economy, the more you know, the more revenue you can yield out of your knowledge, the lower your cost and the greater your profits. So if you want to walk away from this university with only 2 charts, you got them right here. And you better follow the chart to the right than to the left. So this is my advice for your careers. How do you then translate this thing into equations? Again, you are back to the same equation, productivity is output over input. But now, the source of wealth is knowledge capital, which is knowledge value added divided by cost of equity capital. In other words, you are basically going to buy capital, cash, to buy things, buy tuition, buy education. That's commodity stuff. You borrow the money How many of you are on student loans here? How many are on student loans? Okay, so you are cost of equity capital. Hopefully it is a reasonable cost. So then the question now is, for that cost, student loans, as I recall, are running about 4.5%. Is that correct? Correct? So the question is, for 4.5% cost of equity capital, how much knowledge value added can you create as part of your career? So how do you do the calculation? Well, what you do, you take your profit and you pay rent to whoever gave you capital. And of course, the equity rent is cost of equity capital times the equity that you have. So for instance, if you pay, let's say, $10,000 for a degree in this university, which I doubt, but I'll make it simple, and you pay 4%, so that is your equity rent. And so then the question is, with that kind of investment, how much value added can you create? Now, what happens, of course, is that economic theory makes very clear what is the cost of capital. The cost of equity capital is not just the cost of bonds, but also the cost of dividends. And as you could see here, Exxon pays less than Walmart. General Motors is fairly pricey. Ford Motor is in a hock up to their eyeballs. And General Electric has a fairly high cost of capital because they are basically getting 60% of their profits out of financial transactions and out of entertainment. Risky businesses. You know, they get a significant part of their profit out of the show business. So again, the market, and you can go to the marketplace, there's a number of places where you can get this number. It's available from Standard & Poor's, it's available from Value Line and other companies. Now that you understand how to do the calculation, you take the profit, the shareholder equity, you pay rent for the shareholder equity. Your equity rent is then expressed in millions. And now you can calculate the knowledge value added, which is capital, shareholder value minus equity rent. And as you could see here, the Exxon, the high-paying retirement company, has a knowledge value of 19 billion, Walmart 5. General Motors is really negative, which means they are threatened with bankruptcy. They are more dead than alive, and so forth. So it is this kind of analysis which gives you completely new ways of insights on how to look at an organization. So let me then repeat that the knowledge capital is then knowledge value added divided by cost of equity capital. You can calculate it. You can then do the necessary calculation in a proper way. Now I'm going to do a comparison. I showed you the first method of doing the calculation of knowledge capital, which was based on stock market prices, which is market-based knowledge assets, which is the second column, $228 billion for ExxonMobil. I did a calculation of the value of Exxon based on their profitability, which is $314 billion. So what I'm really telling you that ExxonMobil is undervalued as compared to its what's called intrinsic value, and may be a good purchase, particularly after they get bad news and they get thrashed by Mr. Spitzer and by the newspapers, but that's a good time to buy stock. By the way, I'm not offering stock market advice here, I'm just giving you analytics, okay? Walmart is overvalued. General Motors, even as poor as they are doing, is still overvalued, and so forth. General Electric is clearly overvalued. Let me just put this thing into a perspective from a standpoint of the overall economics. I will be doing the 2005 numbers sometimes this summer as part of my vacation. But here are my 1998 numbers, which have not really changed very much in terms of ratios. When you look at the corporate valuation of American corporation, and this is 5,763 US firms. This is a good sample based on Standard & Poor's. The corporate assets are worth $10.9 trillion, of which knowledge assets are the bulk, $7.4 trillion. Plant and property is $3.1 trillion, and financial assets, which is cash and work in process and so forth, is only $500 billion. Market has actually overvalued the economy and was in 1998 at $12.3 trillion, which indicated to me that the market is going to take a downfall, which it ultimately did in the year 2001. But at any rate, what you ought to understand when you look at these United States of America, what holds this country together is knowledge assets. Overwhelmingly. It's not the factories, it's not the smoking chimneys, it's not the cars, it's not the railroads. They're still there. You know, there's $3.1 trillion there. But what makes this country generate a high standard of living is the knowledge assets. And that is the envy of the world. So let me then summarize this portion of the presentation. Value-added valuation reflects my view that equity capital is a commodity. It's a risky commodity, but you can buy it if you are willing to pay usurious prices. If you are willing to pay 18% on credit card debt, well, that's your problem. It's just about not the right way to obtain equity capital. The valuation of the cost is really dictated by the so-called capital asset pricing model. I don't have time to get involved in the theory here of capital asset pricing. Nevertheless, it's a subject that you can look up on Google, and you will get a thorough dissertation on it that will occupy you for at least a rainy weekend. And then lastly, valuation deals with the financial results, and therefore capital becomes what's called surplus value. I don't want to get into the discussion of the history of the term surplus value. Most of you are not steeped in Marxist terms, but that was the favorite term that was used by Karl Marx, who totally misunderstood what knowledge capital was and wrecked all the communist countries based on an error in a very simple equation. Now, I'm not joking here. Lots of theories of this world are based on some very simple assumptions that don't stand up. Nevertheless, they become part of the way how people start looking at reality at great pain, with great penalty to their livelihood. Okay, now that you are equipped to do market valuation and value-added valuation, I'm just going to show you some tricks how to use this kind of a material. The reason I'm showing it here, because some of you may be interested in doing graduate work, and the field of knowledge capital planning and knowledge capital economics is a fruitful field which is largely unoccupied and offers enormous opportunities for doing research and original work. Let me just show you what you can do with, say, General Motors as a case study. I showed you the 2004 numbers, which is the last number for the knowledge capital for General Motors in terms of knowledge capital per employee. Then I plotted in the red line compensation per employee. So as the knowledge capital per employee declined, the compensation per employee kept increasing. Now, anybody who would look at these kind of curves over a period of time would already know what's coming. I mean, this was a company headed for a wreck for the last 8 years, despite all the other pronouncements. So trend analysis of compensation per employee as compared to knowledge capital per employee is clearly a fruitful field for examination. Let me show you something else. And by the way, I found this absolutely fascinating. Much of the conversation in Washington these days is that this country ought to spend more money on R&D because R&D will give you innovation. You have these big conferences. Everywhere you look at it, plastered over the New York Times and the Wall Street Journal, a full-page advertisement about a conference on innovation, which basically is a way of peddling, increasing research and development and asking the government to get you investment credits. I decided to say, well, all right, let's go and see whether some of the firms that I've been tracking for decades now, one of the most obvious examples for a cleanest example with cleanest data is in the pharmaceutical industry, which is very research intensive. You know, this is one of the few places where R&D is clearly correlated according to every paper you ever wrote with stock market valuation. The answer it is not. The market valuation is the blue dots, and as you could see, the valuation of Abbott Laboratories went from 10 billion to the current value of about 70 billion in a period of 18 years. Meanwhile, the R&D expenses went up to approximately $18 billion, which is the green line below. There was no way of explaining the market valuation gain with R&D expenses. In other words, no amount of R&D would have explained the market valuation. It turns out when you look at another factor, which is what's called transaction cost, which I discussed in one of my prior presentations, which is sales, general, and administrative cost, which are the red dots, the round dots going up. They pretty well track over a period of 18 years, market valuation. Now, what does this mean? It has far-reaching implications on the job of a CIO. In that, the ability of a firm to organize itself, to organize sales, which is organize itself internally, as well as how you deal with customers. General, how you do your executive management and internal integration with suppliers, and administration, which is mostly IT costs, really explains, if well done, that it is the transaction cost or information cost component of the company that explains the gain in market valuation. I will be writing some papers on the subject, but I just want to point out to you that those people who go around peddling just R&D budget increases don't have as yet a basis for explaining why R&D alone would entitle a company to profit increases. Let me also point out to you that I'm biased on the subject. I spent 18 years with Xerox, perhaps spent more R&D money on advanced technology than anybody else other than IBM. And we got zip dollars out of it. And we got it not because we didn't spend the money on R&D, we got it because the SG&A component was ill-structured and disorganized. Again, this is a field which describes the arena in which a CIO has to operate. What I would like to show you here is what's called a knowledge accumulation efficiency, which is what's called the first derivative of the relationship between cumulative SG&A cost and knowledge capital. I trust that all of you have passed your math, so you know what a first derivative is. And what this shows, it's a very sensitive indicator. And by the way, this is Abbott. Whether the company is gaining or losing traction in the marketplace. And as you could see, since 1998, when government started interfering with pricing of pharmaceutical, the knowledge accumulation efficiency of Abbott declined. Now, there is a spike in 1991 up and then a downdraft. I went to headquarters, I think it was sometime in 1997, and I showed them this chart. They all laughed, and I said, you know, I can't understand how you spiked up in 1989, 1990, and then went through a downdraft. After that, they said, oh, that's the Hillary effect. And I said, I don't understand. They say, well, this is when Hillary tried to put in effect regulation of pharmaceutical prices. And luckily, we got a new administration after that. So we went back, and now we are declining again because people are trying to recreate, gain control of pharmaceuticals. To summarize the third part, knowledge valuation offers a wide range of analytic methods for evaluating results delivered by information technology. And it is clearly one of the indicators corporate chief CIO officer would have to master as a way of understanding the dynamics of the information environment in which he or she operates. Now, you've been patient, so let me wind up now and do calculations for you while you came. Now that you have been equipped with all the theoretical stuff, let me show you the ranking of 5,253 firms, which I've just completed, and I'm showing you the 10 smartest US firms. You can start filling out your job applications if you wish. What I want to draw to your attention is the column knowledge asset per employee, which is the company that ranked highest, number one, out of 5,253. Now, this company has 24 employees. It's called Ventas. It's a real estate investment trust. And the knowledge assets per employee are $66 million. Okay? Now, that is a pretty sweet place to work. You may actually have a very nice retirement pay out of it. That would be everybody's envy. And again, real estate, mineral royalty, biological research, travel, zoo, never know who they are. They are a programming and data processing company of 38 people. They are worth $583 million. And that means every employee is worth about $15 million. These are incredible numbers. But I want to point out to you that the numbers are what they are. And you say, well, this is unfair. The real estate people are speculators. And the answer is, indeed they are. They leverage their assets by huge borrowing, and their gains in any given year can plunge during the next recession or when the stock market bubble bursts. Be it as it may, at any given time, these people are pretty good and are looking for unloading their stock on somebody who would buy it. Now, I've published these rankings. Smartest U.S. firm is loaded with real estate and oil companies. Oil companies are smart by knowing where to put a hole in the ground. After that, you know, the money just keeps gushing out. Of course, it doesn't tell you all the oil companies that drill dry holes, but the smart ones who know where to put it in and are able to get a license do extremely well. Let me show you now the big corporations. What are the knowledge assets per employees? ExxonMobil has $2 million worth of assets per employee. Walmart, 120,000. General Motors is negative. In other words, General Motors pays their people more than what their assets are, and so forth, and so forth. I want to draw your attention to the knowledge asset employee rank. These companies are the 20 largest corporations in the United States. You know, Exxon, General Motors, Citi, American Airlines, International Business Corporation, Hewlett-Packard, all the big names. None of the big names with large employees make the top rank. So as large companies become attractive as sources of employment, you should never overlook the opportunities which are offered by small companies which consistently have overperformed the capabilities of large corporations. This is a unique American phenomena. So let's then do an analysis of employees. We have Johnson & Johnson, pharmaceutical firms. Knowledge assets range from $1.4 million to $567,000. Employee compensation ranges from $109,000 to $63,000. As you could see, the compensation per employee is clustered fairly around a median value of about $80,000. Whereas the knowledge assets are widely distributed. That is a phenomenon you will always find, that in terms of human capital, when you go to these pharmaceutical companies, most of them have laboratories in northern New Jersey. Their students come pretty much from the same school. The usual 20% went to Rutgers, and so forth. They are basically happily married most of the time, have 2 children and 2.3 cars, and you know, they are very much the same kind of people. You would not be able to say that these people are different. Yet the knowledge assets for these people are enormously different. And the question you should then ask, well, why is it that Johnson & Johnson, with the same number of PhDs as Roche, living in northern New Jersey, with not a significantly difference in the number of employees, have this enormous difference in, no, I'm sorry, I outspoke. It is Johnson & Johnson and Wyeth, okay? Johnson & Johnson is 100,000 compensation, 63,000. The knowledge assets are $1,000,004 versus 913. How is it that you have such great diversity of people basically with the same education? By the way, people who quit Johnson & Johnson go usually to work for Novartis. GlaxoSmithKline people go to work for AstraZeneca and so forth. They are pretty much the same. There are no intellectual distinctions or any ratio you would run on the number of PhDs that would distinguish the difference. What makes a difference is the recognition that employees are a risky asset. And therefore, you have to start looking at employees as an asset, as a risky asset, and the risk is then reflected in the discount rate that you apply to knowledge capital. So now, we're coming to the purpose of our lecture today. What is the annual worth of employees' knowledge assets? Well, it is knowledge assets, which is the capital value. You price it as a risky asset. You then discount it, and you come up with an annual worth of an employee knowledge assets. Once you have that number, all you have to do, you take the annual worth of knowledge asset and subtract employee compensation and find out what is the worth of the employees. Now this gets interesting. What this says is that Johnson & Johnson average net worth of an employee is $59,000 a year greater than what they receive in pay. In the case of a company like Novo Nordisk, the company pays their employees $83,000 or $35,000 more than what they are worth. The question is, what makes the difference? These are companies in the same business, basically competing in the same market with pretty much with the same kind of PhDs in biochemistry. And the answer is, it is the organization of these companies. The thing that separates the winners from the losers is organization, the spirit, the leadership, the qualities that remark and equate excellence. So let me then summarize today's presentation. There are two methods for calculating the worth of knowledge assets. Knowledge is now the dominant corporate asset. You can use knowledge asset for competitive benchmarking, which means as a CIO, not only should you be looking at the budget for IT spending, but also what is happening to the knowledge assets of your company. That creates a new definition of what is the job of a CIO. What is the job of somebody who's an information economist? Effective organizations accumulate knowledge assets. Ineffective organizations lose knowledge asset. Now they can lose knowledge assets by disorganization internally, or by theft, or by breaches of security. So my summary then is that knowledge assets accumulation, not only efficiencies, can measure the performance of a CIO who is truly a CIO, who is looking at the structure, organization, and integration of how people work together. I apologize for the rather heavy numerical contents of this presentation. The video will be available courtesy of Google in about 2 weeks. All my lectures come with a 90-day warranty. And you have my GMU email code here. And if you allow me to use this opportunity for an advertisement for my lecture in fall, I will be devoting it to the subject of systems transformation technology, which is becoming the key issue in steering an organization from obsolete forms of organization and obsolete forms of information technology to a new era, which is based on network and which is used on global cooperation. So I hope that this was not too onerous a presentation. You have handouts, you have places where to ask questions, you will have a video to check up on my calculations. You can use the material to check whether my spreadsheets did not make any errors, and I hope that it has been an enjoyable experience. Thank you very much.